Good evening, everybody, and welcome to Metropol TV, the first 24-hour business channel here in Kenya and East Africa. This is The Smart Investor. My name is Ali Khan Sachio. I'm your host for the next hour. We look forward to interacting with you over the next 60 minutes. Let me start with some breaking news. Governor Njoroge, who was at the spring meeting in Washington. These are the IMF and World Bank meetings. They happen once a year. Everybody who's considered a figure in the financial markets is there, just like at WEF and Davos. This is a big deal. And what I admire about Governor Njoroge is he doesn't stay stum. He gets out there, he interacts. He's been on Bloomberg this evening just as I was walking in. And he was worried about the weather. He put out a weather warning, said, look, he put out a weather warning. He said, look, if the weather doesn't improve, that's going to knock 1% off GDP. We're all looking at the skies. I've said before, if you want to be a sub-Saharan African economist, you might as well be a meteorologist as well. The weather has such a big impact. This was also a warning that came out of the IMF and the World Bank, both of who said that the weather could be a wild card this year, and therefore we got to keep a very close eye. And you know, we've seen this before. We get bad weather, we get higher food prices. Higher food prices leads to inflation, that leads to higher interest rates. It tends to be a negative feedback loop. Therefore, keep an eye on the reins. There is a lot of concern from the governor of the central bank to the World Bank and to every other person I'm meeting. The IMF interestingly spoke of the Kenyan economy hitting 10 trillion shillings this year. Essentially, every year we assume that the economy expands, and the expansion rate from 2018 to 2019 is expected to be 5.83%. This is called the GDP denominator. And obviously, the faster and the bigger the economy grows, it helps all our debt metrics. It reduces the debt to GDP. So I sort of think that the IMF were obviously looking at giving us and rolling over that safety net facility we had with them. The reason we're rolling it over is because when international accounts want to look at our credit, they look at the IMF as a positive. And whatever we're paying for that facility, we get back in lower interest rates. So I think there's a deal that's going to be done. Governor Njoroge spoke about it a few weeks ago, said he was going to the spring meetings, going to engage with the IMF. And I think that's an outcome that we should all be expecting, because what is predicted and predictable is that the government has got to sell a Eurobond pretty pronto. And so I think we see the IMF come out with their program. We see the government go to the Eurobond market again. Essentially, the finances demand we roll over that facility, the maturing Eurobond. Cometh the tax man. Everyone's been talking about the housing fund levy, which is set to be implemented from May the 9th. If you're an employee, you're going to find your salary is 1.5% less because of the housing levy. The employer has got to add 1.5% as well. The last calculation I saw was that this collection is going to amount to $570 million a year. I haven't checked that, but that is a big number. And essentially that gets one of Uhuru Kenyatta's big four, his housing pillar, off the ground if this goes through. There's been some dispute in the court. Some employers, I think, are contesting this extra tax, but essentially the value of it is about $500 million. You take that $500 million, you can probably borrow $2 to $3 billion in the markets, and all of a sudden you've got a proper housing program that you can put into play. So I think that's what I would take away from that. A lot of people have issues with the tax, but let's see what happens next. We tend to find a lot of argument, and then everyone accepts things and kind of moves on. Now let's go to the tea plantations. Bloomberg was reporting that the Kenya tea growers have sent half their workers home because of the drought, has cut the harvest in half. Tea growers sent approximately half of their workers on leave or deployed them to non-core duties due to a prolonged drought that's halved production at leaf processing factories. Last year, Kenya is the biggest black tea exporter and earned 141 billion shillings with a record crop of 492.9 million kilograms in 2018. That was enormous production. The point to make about Kenya and tea is we're like Saudi Arabia is to oil. We are the swing producer. If we have a good production, we put the market into surplus. If we have poor production, we put the market into deficit. Normally one offsets the other. So if less tea comes on, we tend to get better prices. More tea comes on, we tend to get lower prices. But when you add it together, it tends to work out at around this number, which is $1.4 billion. But bear in mind, tea is no longer the biggest foreign exchange earner in Kenya Inc. Do you know what it is? Remittances. That is money sent from our brothers and sisters who don't live in Kenya, sending it back to Kenya. That was $2.4 billion last year, a record, and up about 36% year on year. It really has been one of the defining phenomena of the last 20 years. That's remittances. And I like to think of remittances as the monetization of our brain power. It shows that we can go anywhere, we can earn a living, we can send our money back. I see it as a silver bullet. And I think it is that surge in remittances that has kept the shilling so strong. And I think people underestimate that amount. And in fact, 2.4 billion is the official amount. It's probably much higher. Think of it. Not everyone is ticking a box and saying this is a remittance. Some people are giving it to friends to bring home to their parents. Others are doing other things through informal channels. So remittances, big deal. Tea comes second, $1.4 billion. But this year, the drought is shrinking production. We've got to keep an eye on that because so many of our people depend on the tea business. Now let's move on to the rest of Africa. Mozambique, of course, had that incredible cyclone in Beira, which is in the north of Mozambique, closer to the Tanzanian border and then closer to us. They're saying actually that weather system that hit Mozambique and Zimbabwe took the rain away from Kenya. It dragged it south. And that seems to be the reason why you can peer out of the window and you can't hear any rain at all. But the point is, Mozambique, which has found this enormous amount of natural gas in the deep sea, this was found by Andarco actually, and Eni, the Italian company. Andarco was recently bought out for $33 billion, not predominantly for Mozambique, more for oil in the Permian Basin, which is in North America. But you know, there was this enormous scandal in Mozambique. They borrowed about $2 billion from the international markets. One bank was VTB, a Russian bank. The other bank was Credit Suisse, where I once worked many years ago. They borrowed that $2 billion and said, we're going to buy tuna boats to fish tuna. And everyone said, my goodness, $2 billion on other things were there as well, maritime security to defend the boats against pirate attack, amongst other things. Those boats never fished once. $2 billion disappeared. The currency collapsed. The IMF refused to give them any more money. The bonds collapsed. So you had this sort of boom as everyone anticipated the gas. I was down there in 2014. The IMF had a conference, Africa Rising. The whole government was there. The place was booming. You saw cranes everywhere. And then bust because they borrowed all this money and misspent it. And we're still dealing with the aftermath of that. But the point is, one of the companies that was involved in the borrowing of this money was an Abu Dhabi-based company called Privinvest. And Privinvest are now suing the Mozambique government, saying, you know what, we raised this money for you, but you've breached the contract. So interesting times, but a lot of people keeping an eye on it. And this is what they call, you know, they say it's a resource curse. Now they're talking of a pre-resource curse. Before you even got it out of the ground and earned any money, you're starting to spend it. We need to be careful, and I'll get to that in a second. But essentially, Mozambique, a cautionary tale, right? From boom to bust. It will boom again because they got so much gas, it's as much as Qatar. But the point is, they did mess up, and they messed up big. And unfortunately, part of their poor response by the government is, I'm sure, they were short of money. You know, Beira, opposition stronghold, not really bothered about it, and they had that huge flooding. Now, let's carry on, and let me turn to Zimbabwe. Zimbabwe, look, you know, the economic indicators are not looking good. But President Mnangagwa has asked the British to help him compensate the British white farmers who, you will remember, President Mugabe threw off their farms, gave most of those farms to war veterans who weren't farmers, and all these farms went to waste. It's quite terrible if you look at what happened in Zimbabwe. Essentially, it was the breadbasket of that region, and people will tell you that, you know, they grew enough food to feed every one of themselves and export to the rest of the region. But post that whole period, when Mugabe got upset with the British didn't want to give him the money to buy out the farmers because they said, you're not buying out the farmers, it's just your friends who are buying all the best farms and your wife. We won't give you any money for it. He gets upset. He starts that whole farm invasion saga. Now, President Mnangagwa, one of the conditions, I think, to sort of normalizing the Zimbabwean situation is compensation has got to be paid. And he's gone to the British and said, look, why don't you help me out here? And he's asking for, wait for it, $3 billion, i.e. more than 2 years of income, of our tea income. I don't think 3 billion is there, and I don't think the British, you know, in this moment of Brexit, although they want to support Zimbabwe, are going to pony up that kind of money. But we're yet to find out. Zimbabwe has budgeted $16.7 million for this bailout of the white farmers. So let's see how that goes. But more worryingly, let me get to the economic data in Zimbabwe. Annual inflation has risen to 66.8%. That means that the value of money is declining by 66.8. So just put that in context. Each 100 shillings that you've got in your pocket, if you kept it there for 12 months and you lived in Zimbabwe, would be worth 32 shillings after 12 months. Now, that is not a good thing, is it? Obviously. That means your spending power has shrunk. So what we've got is runaway inflation. You must remember that they did have this hyperinflation period during the time of Mugabe when it went to some mathematically impossible amount of a billionth of a percent. You know, they were having to bring wheelbarrows, and by the time you'd fill the wheelbarrow, the money was worth half of what it was a minute ago. And we got a similar problem developing there, and we got to keep a very close eye. And just as I was coming in, I heard they've put up bread prices by nearly double. And that was announced just this evening. And you know about bread. If you can't feed the people at a reasonable price and they don't feel that they're getting a fair shake of the dice, where do they go next? They get on the street. The last time the Zimbabweans were on the street was when petrol prices doubled overnight. Now you've got bread prices doubling overnight. This, of course, was one of the problems for our friend up north, Omar al-Bashir. Suddenly his people were having to pay double or triple bread prices. What happened next? Maputo, bread riots. I remember being in Indonesia in 1997, 1998. There too, the president was asked to remove subsidies, and he turned to all of us in that room and he said, I'll be gone in a week. And he was. So you don't want to play around with food prices. This is the first lesson if you want to remain an incumbent. Let's keep an eye on what's going on there. Sudan's political crisis. Well, the protesters maintain that Sudan's military must leave power. Our demands are clear and have not yet been achieved. Why would we go home? Our sit-in is the most powerful weapon in our hands, and indeed it is. And you know, there's a very famous quote by one of my favorite writers, an American called Don DeLillo. He's brilliant. He writes about contemporary events. And he said, the future belongs to crowds. And right now we have a crowd on the streets in Sudan. And the question is, does it belong to those people in army uniforms, or does it belong to the crowd? The army want a 2-year transitional council. The crowd says, out. We don't want you anymore. We want a democratic government. Who will win? The crowd will not win if they go home. If they disperse, they will lose. So what is the latest leader? And of course, there was one leader who said he was going to be there for 2 years. He lasted 24 hours. He was Bashir's sidekick. That was never going to work, was it? But the current chap is saying 2 years again, and then apparently tried to remove everybody from the street and wasn't successful. Everyone did a chain and wouldn't move, and they're completely right. The day they leave the street, they've lost. So watch that, and watch it in Algeria, and keep an eye on Zimbabwe, because they've just had a doubling in bread prices. Now, Turkey. President Erdogan, who's got this King Canute complex. Do you know King Canute? King Canute was the king. Everybody said, you can do anything. You are our king, king. And he said, yes, I can. And they said, you could even stop the waves. And he went out there into the sea and he said, tell the waves to stop. And the waves, of course, didn't listen. And he drowned. I think he drowned. So the point is, we've got the same problem with Erdogan. He thinks he can tell the market to do his bidding. And the market will not. He's bought these S-400s from Vladimir Putin, and he's meant to be a NATO ally. And the NATO, his NATO partners are saying, look, buddy, you can't buy those S-400s. It compromises our defense system. So that's the first point of contestation. And what is happening now, you've got a very weak currency. His son-in-law, who's the finance minister, apparently who's also at the IMF and the World Bank meetings in Washington, where Dr. Jarogi is, was speaking to 400 investors yesterday, and all of them said it was the worst presentation they'd ever heard in the last 20 years. And what we're seeing here is a perfect cocktail for another big sell-off in the Turkish lira. So if you're thinking of buying anything from Turkey, wait a bit. You'll get it a lot cheaper, I'm sure. And of course, Turkey is a very developed country. Lots of things come out of there, textiles, all kinds of things. Now, let me move on to a crucial thing, the price of oil. The chart you're seeing up there is the price of oil in New York. It's around $63.67. Where this goes from now is really important, and it will be a pivot for the global economy. I don't need to tell you about Kenya. We're a net importer. Biggest check we write every month is for our oil bill. So it makes a huge difference if we're paying $60 or 70 or 80. The last time the shilling went into a tailspin was when oil went as high as $142. I'm sure you've forgotten that, but I haven't. And quite often, food prices plus a surging oil price does not bode well for us, because we get a double whammy. So we've got to keep a close eye on this. And bear in mind that the oil economy is worth $2.5 trillion just in terms of the number of barrels produced every day times by 365 days. Then people trade futures and options on top of that. So the total oil-based economy is $5 trillion. It's huge. It's about 3% of global GDP. It really matters. It's one of the big elephants in the room. Now, I like these quotations from a very famous Polish writer who came to Africa. He's written about Africa. His name is Richard Kapuscinski, and he's dead now. But he's written about all kinds of things, the Angolan Revolution, fantastic writer. But he's written a book called The Shah of Shahs, which is about the downfall of the Shah of Iran. And it's worth reading, very short, 100 pages, take you a minute. In that book, he says, oil creates the illusion of a completely changed life, life without work, life for free. Oil is a resource that anesthetizes thought, blurs vision, and corrupts. And he also says, oil kindles extraordinary emotions and hopes, since oil is above all a great temptation. It is the temptation of ease, wealth, strength, fortune, power. It is a filthy, foul-smelling liquid that squirts obligingly up in the air and falls back to earth as a rustle of money. And when I listen to some of the folks up in Turkana and other folks, these are the sorts of expectations they've got, haven't they? That it's going to just go up and a rustle of money is going to fall back down again. So he's not wrong. Last 2 points I wanted to make. There's a fantastic report on Bloomberg about crypto trading. And what it's saying is special arbitrage bots, a bot is of course what you probably know what a bot is, are anticipating and profiting from ordinary users' trades in the cryptocurrency markets. And according to this report, just on 3 exchanges, there are 200 bots who are each earning $20,000 a day. Go and have a look at that story. It's very interesting. But what it does tell you is that the cryptocurrency market, it's not clear what is right and what is wrong. Let me finish off with President Trump. President Trump has been attacking this Muslim American lawmaker, Ilhan Omar, who was in one of our refugee camps for many years before her family and her went to America. So a lot of people here in Nairobi actually know her. And he's been calling her out of control, a purveyor of hate speech. And the point is this: it is Trump who is the puppeteer. There is no way Ilhan Omar can be the face of resistance to Trump. It's not possible. It's politically impossible. And that's exactly what he wants her to be. And she's playing into that. We need to watch that very carefully, because if things go this way, it's going to be a landslide for Trump. It really is. And he's playing a very sophisticated political game. And these young folks, Ilhan, who I admire, Cortez, another interesting young lady, sharp, clever, brilliant. But the thing is, he's playing them like a violin. He knows exactly what to do with them. Because if it's Trump versus Ilhan, Trump is coming with a landslide. If it's Trump versus Cortez, it's another landslide. They need to get a bit smarter, because politically, they're not acting that smart. They're just standing there, they're putting a sign and saying, please shoot me. It's not a clever idea. And Trump, look, the man became president, he's looking more and more likely like he's going to win again. And with that, we're going to take a break. This is The Smart Investor. This is Metropol TV, the first 24-hour business channel here in Nairobi. And I've got Maurice Oduor coming up. He's from Saiton. He's the investment analyst, strategist, thinker. We've got lots of interesting things to talk about. I hope you join us after the break. My name is Ali Khan Sachu. This is the Metropol TV, The Smart Investor. Welcome back to Metropol TV, The Smart Investor. My name is Ali Khan Sachu, and we've got a great guest in the studio today, Maurice Oduor. Maurice is the Principal Officer, Saiton Asset Management. Maurice, we've had a lot of people talking about our economy. We've had the President talk about 6.3% GDP. We've had the World Bank say, hang on a second, looks like 5.7, and we got this wild card is the drought. If it gets worse, that's going to... I saw just before I came in the studio, Dr. Jorogi, the central bank governor, saying could knock 1% off GDP. Is the glass half full or is it half empty?
I think if you look at the GDP growth expectations for 2019, at least now we've gotten view from 3 independent institutions, at least, but both of them are forecast in terms of direction, they are in the same direction. Look at World Bank, slowing it down, mainly attributed to the weather outlook. Look at again World Bank, weather outlook, also reduce government investments. Listen to Governor Njoroge, also reduction as a result of weather outlook. So what this tells us is that the imminent risk that we face as a country, that the delayed rainy season between March and April will likely affect economic growth. But if you look at the figures, the projection we are having still is not bad compared to the Kenyan historical GDP growth rate. We are talking about 5.7, 5.8% compared to where we were last year, which is about 5.7%. 5-year average coming to about 5.6%.
Maurice, in those reports, East Africa, particularly in the African Development Bank, was a bright spot. If you compare it with Baba Goslow's Nigeria, where the rate of a GDP expansion is less than the population growth. South Africa, same story. Under Ramaphosa, he's trying to turn it around. And when you look at our economies, they looked okay. But when you go and speak to people in the street, they're not saying that. They're saying, we can't feel it. We don't know what you're talking about, Ali Khan. We're not seeing 5.7. What are you talking about? No one's experiencing it. Is there a disconnect between the economic numbers and what people are experiencing? Is cost of living running away or something? Why are people feeling it that way?
If you look at the growth, GDP growth we've experienced, let's say, over the last 3 to 4 years, The growth has been there, but not trickling down to people. If you look at what has been...
So no trickle down is what you're saying?
No trickle down effect. If you look at what exactly is driving this economic growth, mainly has been as a result of infrastructure development done by the government. If you dig deeper to this infrastructure development done by the government, even in terms of people that are being employed, most of them are not even Kenyan. Most of them, you look at most of these projects are financed by Chinese loan. We end up even in a situation where we're even importing labor. So they are kind of projects that we can refer to as they are jobless projects when you look at now in terms of employing Kenyans.
But do you feel they're going to deliver what they're saying on the ticket going forward?
It's going to be difficult. There are going to be a lot of sacrifices we have to make as a country in terms of how we finance our projects and in terms of how we manage the entire public finance fiscal management framework, which needs to be looked at critically so that at least we run a lean government that is most efficient, focused on delivery of services to Kenyans, with a key focus on job creation. Yes.
But you know, there's the politics. Reducing government, in my experience, is practically a near-death or impossible experience. I can't find governments which reduce their size without significant amount of pressure, without their feet being put to the fire. Do you think there's a will here to do that?
I think if you look at where we've come from as a country, we've come from a situation where the president had the free will of determining the number of ministries they will create. Everything was within the hand of the president. Now we are in a situation where at least it's in the question the number of ministries that the president can create in any specific dispensation. I think we are not yet there, but we are making significant steps in terms of moving to a situation where now everything will become more predictable and they are not left at the wishes and the wills of a specific individual.
Let me now take you to the equity market, because you are, after all, the principal officer. The equity market, good year. I see NSE All Share up 12% already. It was annus horribilis last year. Everyone lost money. We've had a good start. I think only Egypt and South Africa ahead. Egypt 15%, South Africa behind, actually 10%.
Yeah.
Where are you looking at within that market complex? Because when you look at it, it's quite bifurcated, right? There's success and there's failure. And if you choose wrong, it's pretty Darwinian, right? If you could pick Safaricom and some of the strong banks and your timing was good, you're laughing. If you didn't and you went for some of these mumiases or something like that, I mean, your money just disappeared. Where, Maurice, should we be looking at? Because this is called a smart investor. Tell us how to be smart.
If you look at the performance of the securities exchange, especially for this year, you're already up about 12%. And if you break it down to what are the key sectors that have been driving this growth, the growth has been driven by the recovery in the banking sector, which mainly came as a result of this better earnings they reported this year compared to where we were coming from this year, which again resulted into better dividend payout. We've seen most banks now rewarding shareholders, even a bank like KCB now paying dividend of total, looking at about 3 shillings a share. Look at Equity Bank still maintaining 2 shillings a share. Look at even Cooperative Bank. Look at I&M with a bonus of 1 share for every one, which if you look at in terms of the driving the stock market performance, has mainly been driven by banks, not ignoring the performance of Safaricom, which now control almost a quarter of the market. So if you make your choices right, you have to be within the banking sector, and within the banking sector, not everything within that sector is also good. You have to be choosy. You have to be clear in terms of which stocks am I going with, and which stocks have proper growth potential that will even result into good earnings growth, effectively distribution of good dividend to the shareholders.
So let me ask you, is it a survival of the fittest moment in the banking sector that the big boys are getting bigger and stronger, and you're getting this process of consolidation, and the smaller boys have really got to look at whether they raise capital or do something in order to get out of that sort of tier 3 situation, because they're the ones who've been suffering from the rate cap, right? I mean,
yes.
Their borrowing costs have remained high and they're capped in their lending rates. So for you, what are your top picks in the banking sector? What would you tell us to be looking at?
If you look at banking sector, you can say survival for the fittest.
Yeah.
But I'm looking at banks that have specific niche that they are serving.
Yes.
I'm looking at banks, the most innovative banks in terms of how they do business.
So who have the best niches? Who are the most innovative in your opinion?
If you look at the banking sector, the sad news that most of banks that has all those characteristics I've talked about still remain the big banks. Talk of KCB, talk of Cooperative Bank, talk of Equity Bank. These are banks that already identify specific niches they serve. These are banks that are very innovative in terms of how they are doing business. Fintech are coming in the bank so that at least they run most efficiently, reducing their cost to income ratio, and again now resulting into higher earnings growth, which again now leads to proper dividend distribution to shareholders.
About this fintech business, right? I mean, I can see the banks have all adopted fintech. I mean, you've got KCB M-Pesa, you've got CBN Shwari, you've got Co-op M-Pesa. So they've all sort of kind of brought it into their ecosystem. But last year, I was watching things like Branch and Tala, which are these fintechs, right? The capital those guys were raising was more than our banks were raising, right? You know, I think Tala put their hand up, they got $170 million in a flash, right? Are they disruptors? Have their banks adopted to them, or what is the future of that whole intersection point?
If you look at technology and financial services, I say we'll always need banks even 1,000 years to come.
Yes.
But we'll not need banks the way they exist. If you look at even how we need banking services currently and picture back how banking services were 10 years ago, it's a totally whole different thing.
It is.
So banking sector, financial services, and technology will have to come together. People, institutions that will embrace this phenomenon very fast will get the benefits.
Do you feel any specific institution has done that?
If you look at, again, I'll go back to the top tier banks in Kenya. They are really embracing technology. They are really looking at ways of efficiently delivering banking services to their customers. Look at Equity Bank, the most innovative bank in terms of fintech. Look at KCB, they are partnered with Safaricom in terms of KCB M-Pesa. Look at even Cooperative Bank. Look at even other banks will move slightly away from technology. Look at even other banks having innovative ways, agency banking. The key thing for this to be efficiency in terms of service delivery to their customers. Banks that will effectively embrace this will get the benefit. And we've already seen top tier banks. Look at even KCB, look at even the non-listed one like CBA. They are really benefiting from M-Shwari and M-Pesa partnerships. So fintechs and banks, the future of these two sectors is when they are together.
Let me ask you a technical question. You know this merger between CBA and NIC, reverse basically merger, isn't it? Because you're coming in and they're going to use the listing of NIC.
Yes.
From a value perspective, is this a good deal? How do you see that? Do you see it as an opportunity? Should shareholders be now buying NIC bank shares in anticipation of this merged entity?
If you look at NIC, CBA, two banks sort of serving like the same niche in the market. If you move further, again, you can say two banks competing. So there's synergy if they come together. Because if you look at they also have like complementary advantage in terms of NIC was not that technology driven if you compare to where CBA was.
Yes.
So NIC will stand to benefit from efficiency driven technology from CBA. If you look at even in terms of their branch network, they are almost moving in the same direction. So I'm seeing a situation where between NIC and the CBA, they're going to be remapping of branches. Other
Job losses?
Job losses are going to be slight.
Because normally when banks merge, that's the first thing they do is cut costs.
If you look at even, not even as a result of this merger alone, look at even the trend in the banking sector, they are cutting down jobs because they are embracing technology. And if you look at even in terms of now benefits that are supposed to come from this, people shareholder NIC tend to benefit more from CBA as opposed to CBA benefiting from NIC.
But you thought it was a fair ratio?
It was a fair ratio in terms of how the transaction was structured. But in terms of now going forward, I think shareholders should look at NIC better. Investors should look at NIC better because they have value to be driven from this merger that will effectively benefit the investors in that stock.
Let me now turn your attention to another segment that you look at. This is the insurance sector. I mean, the insurance companies all reported, I can't think of any, so far has anyone reported positive results year on year?
CIC.
CIC?
Yes.
Okay, then you'll explain to us why. But, you know, it was a very difficult year. They were hit on their portfolio asset values.
Yeah.
I saw very little growth year on year in insurance premium. Was that a correct read overall?
Yes.
So tell us a little bit about what's going on in there and what you think and what is the value and where would you be looking?
If you look at the insurance companies in Kenya for 2018, the performance was very poor. So far, only one insurance company has reported profit growth, and that was CIC.
Yes.
Mainly driven by strong growth in terms of gross premium collections. But if again you go back and look at even in terms of their return from the different investment they made, it was not that significant. For CIC, was an outlier, mainly driven by the premium growth. But in terms of specific assets return, the trend was the same. Poor returns from listed stocks, which mainly insurance companies should invest there. And again, most of them are skewed towards banking stocks. If you look at even performance of government bonds, the yield curve was relatively stable during the year,
yes.
which again did not reflect much in terms of the return in that asset class. If you look at even performance of real estate, again, most insurance companies that have exposure in real estate talk of Britam, talking about occupancy slowdown at Britam's towers.
So they were heavily overweight real estate.
Exactly. Look at Kenya Rio, also talking of slowdown in occupancy rates. And there were some specific factors that were specific to specific insurance companies. Britam talking of one-off cost in terms of staff reorganization. And you look at Sanlam talking about bad investment written off as a result of investment they made in the past in terms of some commercial paper investment that they decided to write off in the year 2018. So if you look at all these perspectives put together, the insurance company suffered as a result of poor returns from the stock market, a slowdown in terms of return from the government securities, slowdown in terms of their real estate returns, and also specific factors that were specific to different companies, write-off for bad investment, and also staff reorganization cost. Going forward, what I think insurance companies are supposed to do, and investors are supposed to look at where Kenyan banks were 15 years ago. And how I look at things, that's where insurance companies are right now. What they need to do, they need to come up with innovative ways of conducting business, which was done by banks. Banks have gone through an evolutionary phase that have now made them move to where they are. Insurance need to move the same, and again, education remains key, because Kenyans have come to a point where now they embrace banking services, but it's not the same when it comes to insurance services. So we need to educate investors more. They need to understand why do we need insurance policies, so that at least people embrace insurance. Insurance come out with innovative ways of conducting business that they can benefit from efficiency, even in terms of premium collection, and also just conducting the day-to-day running of affairs with an insurance company.
Because, you know, Morris, I met a guy who said to me, Ali Khan, the insurance sector doesn't know what's about to hit them. It's all going to be data-driven and it's going to be so disruptive. Is that what you think as well?
It's true, because if you look at insurance segments in Kenya, there's still a lot of opportunities.
Yeah.
Look at premium to GDP, still playing around. Insurance penetration is still around 3%. But if you look at the access to banking services in Kenya, it's going to almost 70-75%. So there's a lot of opportunities in insurance segment moving even.
Is that why we've seen so many people buy into that? Swiss Re,
exactly,
Prudential, these African Vest.
Exactly. If you look at now the entry for global insurance companies and investors seeing opportunities in the Kenyan insurance sector, if we manage even to move insurance penetration rate from 3% to 10%, it's going to be significant, because where we are at 3%. If we move 3%, this 3 times to 10%, it will be a very significant total different ball game. But the caveat here is that insurers need to be innovative and embrace what Kenyan banks did from 15 years ago to where they are currently.
That's a great point.
Yeah.
Morris, you touched on the bond market, the government of Kenya bond market, and I just want you to comment on 2 things. I met somebody who said, Ali Khan, all our banks are so heavy, overweight government of Kenya bonds. What happens if there's a downgrade? It's a double whammy, isn't it? Because you can't, do you see that as a risk at this moment, of any risk of that nature?
If you look at the trend in the banking sector, why Kenyan banks and the most skewed towards government sector, it's a risk trade-off. Because if you look at the interest rate cap that now placed a cap in terms of pricing of loans. So if I place an SME on the same platform, that now do I put this money into a government bond, or do I give out a disbursement?
You're better off with that government.
I'm better off with the government bond. So most banks have been moving towards government bonds. Government bonds recorded a growth in terms of look at the entire banking sector's balance sheet. Allocating government bonds increased almost by double digits.
Yes.
And you look at loan growth was about 3%. So it's a risk trade-off that banks are willing to take. They are better off with government bonds as opposed to giving loaning to private individuals, which again will result into growth in non-performing loans.
So private sector credit growth, according to your theory, is going to remain subdued, because what is going to move the banks out of government paper and lending unless and until the rate cap is removed?
If you look at private sector credit growth with the rate cap still in place, will still remain very low, because risk analysis, risk framework will not allow you to allocate money to a private sector loan, to issue out loans as opposed to putting government securities. So banks that will benefit, so long as you can gather deposit properly, you are strong in terms of deposit gathering capability. It's very easy now, you just allocate government bonds. But what we need to address as a country, because when private sector is crowded out of credit market, even economic growth will not be able to record much, because it's private sector. Government is supposed to provide a conducive environment for private sector to thrive, create jobs. People get jobs, get employed, and they've implied, and again, in turn, pay taxes, which again is used to fund the government. So we need to address the interest rate cap, so that at least be able to activate the growth of private sector credit.
Couple more questions. Shilling, are you bullish or bearish?
If you look at shilling for this year, we've been relatively stable, despite the withdrawal of the standby, the expiry of standby facility. But if you look at shilling, in the short term, shilling will remain stable. But going forward in the long term, there are things we need to put in place. We need to look at even our debt structure, because currently we have appetite for governments more towards foreign denominated debt instruments, especially Eurobond.
So we can't afford a weak shilling, because if we get a weak shilling, our debt to GDP ratio will go out.
Exactly. We can't afford a weak shilling. A stable shilling is better for us. Stable, because even if you look at Kenya, still a net importer country, we need stability in terms of currency. But we need to address a number of things. We need to address our import-export structure. Let's import things that we are supposed to import, not just importing for the sake of import, so that at least we reduce that deficit between import and export. We need to promote our horticulture, so that at least we earn more foreign exchange. We need to deal with tourism again, so that at least we attract more tourism, we earn more foreign exchange. And now, again, another thing that we need to do, we need to deal with our debt structure. What percentage do we want to be foreign denominated?
It's 51-49.
It's 51-49 currently.
Is that okay?
It's not where we're supposed to be. Because
you'd like less foreign?
I like less foreign. If you look at Alican, where we were in 2014 when we issued the first Eurobond, shilling was at 83.
Oh.
Now we are fine. The first 5 years maturing in June, 3 months to go.
Yeah.
And now we are going to pay when shilling is at 101. Moving from 83 to 101, it's about 25% in 5 years.
Yes. So the interest rate in that period is, you got to add 5% a year.
We are going to add 5%. If you add 5%, it was about 5.75%, taking us to almost 11%.
Maurice, before I leave you, your top trade for the year.
My top
trade for the year.
If you look at my top trades for the year, more skewed again towards banking sector. I'll go to that sector, look at banks, strong earnings growth, capable of paying dividend, trading at a historical, trading lower than at a price to book trading lower than the historical level. Then I'll go into that sector. Equity investment is a situation where equity investment rewards long-term investors, people who are patient. I'll give you an example. If you look at Safaricom, when the Safaricom did the IPO in 2008, IPO price was 5 shillings. 2011, I remember, was a dealer, Safaricom, I traded at 1 shilling and 95 cents. People who could not wait, they said, okay, to hell with this thing, let me sell, I get my 1 shilling 95 cents, I'll never touch any stock again. People who persevered, last year Safaricom touched a price even of 33 shillings. Yeah. If you look at from 5 shillings to 33, is almost more than 600% return in a period of from 2008 to 2018, 10 years. 10 years I made 600, translate to 60% per annum. I'm better off. So stock market, go to that segment, look at banking sector, banks that are good, strong earning growth, innovative banks, trading at a lower than historical in terms of price to book, then put your money there, but don't be in a hurry. Wait. Stock market will reward people who have long-term investment horizon and are willing to wait.
Maurice Odor, Saiton, thank you so much.
Thank you.
This was The Smart Investor, Metropol TV. My name is Ali Khan Sachi. It was a pleasure to have Maurice on today to give us a deep dive into what's really going on. He even gave us some good suggestions. Thank you very much, Morris.
Thank you.
We look forward every weekday, 8 to 9 p.m., Metropol TV, The Smart Investor. My name is Ali Khan Sachu. Hope you have a good night.